All right, so we wanted to get some content out there early this week, based on the fact that we've had some volatility again in markets as the year has continued to roll along, and this conflict in Eastern Europe has continued to make the headlines every day. We just wanted to provide some historical context, a little bit more information around where we sit today, where we've been from the last time we had a market volatility call, which is January 25th, and just where we are, where we think we're going, and some action items as well. A couple of housekeeping items on our end. We plan to be delivering a little more content as well. We've teased at it a bit over the last few months, but we do have a podcast coming out in the coming weeks. We're hoping should be a monthly cadence. We'll provide updates similar to these calls, but with a little bit more specific topic knowledge. We don't have a name for the podcast yet, so if anyone wants to get creative and send us some info, feel free. But with that, keep this very brief today. It'll be 5-10 minutes. Feel free to share it widely. And just a quick disclosure that obviously nothing we're discussing today should be construed as financial, legal, tax advice. Please contact us with those individual situations as always, and we'll take it from there. So with that, I'll kick it over to Matt and Aaron, who are both obviously on this one with us, and let you guys take it away.
Thanks, Pat. So we talked about when we wanted to do one of these calls again, given what had gone on in the Russia-Ukraine situation. And we decided from a market perspective, let's wait until the market really sells off to the point where it's actually worse than it was when we last did one of these, before Russia-Ukraine invasion about 6 weeks ago or so. And basically, as of today, finally, some market indices, not every one, but some have crossed through their late January lows. So we thought it would be a good time to just give an update on where we are. As Pat mentioned, some historic context, couple action items, and and then we'll go from there. So just in terms of where the markets are, year to date in the U.S., S&P 500's down about 11.5%, 12% as we're doing this. So certainly solidly in correction territory, which is defined as a 10% sell-off or more, but down right now right around 12. Foreign markets down about 15. They had been actually outperforming the U.S. until the last few days here. And then NASDAQ, which we look at here because it's been the best performing area of the market, the large U.S. tech stocks over the last several years, really struggling this year, down about 18%, give or take, from year to date. And then on the positive side, let's look at what's working in the market so far this year. And it's really a story of gold and commodities, both inflation, disaster protection, and then everything going on with the Russia and Ukraine. So effectively, the gold ETF is up about 11% year to date. And some of you may be familiar with a broad-based commodity ETF that we hold in our portfolios, managed by Wisdom Tree. And that's actually up over 30% year to date, which certainly when we added it to portfolios, we did not anticipate that type of move this quickly. But the reason we own that is to hedge against some lean times in equities, and it served its purpose and then some to start the year. In terms of just a little bit of historic context, we were looking at some research recently that looked at basically about 15 geopolitical events that have happened starting with World War II around and how the market behaved a year within different periods, a month later, 3 months later, but really a year later. And what we found looking at those was, roughly speaking, about 2/3 the market was actually higher a year later. So that's kind of similar to normal times. Markets are up usually 2 out of every 3 years, give or take. And of the times where the market was down a year later, there were a couple noticeable and notable events that probably were not geopolitical related. For example, one of the events cited was the Russia invasion of Georgia in 2008. And yes, the market was down a year later, but we also had the global financial crisis. So I'm not sure we can blame that on the invasion. Point being, though, on average, a year after these events, the markets were up and up about, give or take, about 5%. That is not to say that this time the markets are going to go up from here. We don't know that. I don't know that anyone knows that for sure. But we do think there are a few action steps that you can take in any event. So one of those is for those with taxable accounts, it is possible now for the first time, maybe in a little while, that we have in your portfolios some securities which are down, which are at a loss right now, an unrealized loss. Probably not the worst time, as Pat highlighted in our monthly newsletter last month, to harvest some tax losses. That is effectively take the loss, replace it with a security that leaves the portfolio largely intact from an exposure perspective, but is different enough to harvest that loss and effectively have the government share in the pain of the loss while you keep the gain of the securities that are up. So that is one potential action step. Two is we find times like these are a really good time to assess not only your risk tolerance, which is sort of can be a little bit more of a subjective metric, but to really be objective about when you need cash flow from your portfolio. Is that portfolio truly as long-term as you thought it was? And if it really still is, if we're investing portfolios 5 years out, 10 years out, then I would argue there isn't a whole lot of need for much action at all, other than maybe taking advantage of some opportunities. But if it's determined either through a reevaluation of your situation or a change in your situation that some cash is needed sooner, we should talk that through and see if there is a plan to work out there. And then finally, and this will segue a little bit into some of the portfolio actions that we may take over the next couple of weeks, to the extent that you are sitting on a lot of cash for one reason or another. You sold a property, you sold a business, you got a bonus. This is around, for you corporate people, corporate executives out there, this is bonus time. You might be sitting on a lot of cash. We are not calling a bottom. In fact, in our portfolios, we probably won't aggressively add to stocks unless there's an additional maybe 5 to 10% sell-off. However, if someone is sitting on a significant amount of cash that you don't need for several years, this probably is a decent entry point and something that should at least be discussed. So that's all I had today, just as a general market overview. I'll turn it over to Herin to close us out here.
Thank you. Just to reiterate, every person that we work with has a different objective and time horizon and goal for their money. So, blanket statements, hey, we should be buying, we should be selling. In theory, they're great, but the reality is every person has a different objective. So the one-on-one conversations that we like to have are critical. What we'll always say is, comfortable investing, doing what's easy, usually is not usually, but a lot of times is not the right thing. You have to be sometimes uncomfortable going against your instincts when the markets are bad and people are fearful. Those are, like Matt said, those are the times to invest if you don't need the money for a long time. So again, although uncomfortable and definitely have to take a step out of your comfort zone potentially, these are the times that you can really advance your wealth, advance your plan if you are methodical about it. So we know times are stressful. We're here to have talks when you do need. So if anything comes up, please let us know. Again, thanks for your time. We tried to keep this brief so you can get back to your day, but thank you again. Anything you need, just please let us know.
Thank you all. Thanks, Matt. Thanks, Herin.
Thank you.
See you guys.
Thank you.